What if I told you that a prediction made right here on Smart Stock Sam, a call that many of you thought was way too bold, is now playing out in real time, right before your eyes? What if the company that critics dismissed as a money pit is suddenly generating $40 million in quarterly profit, dominating China's premium SUV market and pulling in some of the most powerful institutional money on the planet? And what if the window to act is closing in less than 7 days? Welcome back to Smart Stock Sam, the channel where we do the deep work so your portfolio doesn't have to guess. And today, we are going all in on NIO. Institutional giants are loading up. A massive product launch is happening tomorrow. Earnings drop on May 21st, and the chart is drawing a textbook $10 roadmap that is almost too clean to believe. We are talking about a 71% surge in year-to-date deliveries, a golden cross that just fired on the long-term chart, over 134 million shares sold short, just waiting to get squeezed, and a battery infrastructure moat so wide that Tesla and BYD are still trying to figure out how to cross it. This is the video you need to watch before May 21st, so let's get into it. But before we go forward, we have to go back, because this move did not come out of nowhere. If you've been watching the tape this week, you already know. NIO just ripped 7.57% in a single session, closing at $6.54. Now, for some of you watching, that might look like random market noise. But for those of you who were here when we flagged the tactical entry window between $5.50 and $5.80, you know this is anything but random. We called it. The $6 confirmation trigger fired exactly as modeled, and the primary target was hit in just 4 trading days. 4 days. That is the power of disciplined, data-driven analysis, and that is what Smart Stock Sam is built on. But here is the number that should really shake you awake. NIO's year-to-date delivery growth is sitting at 71%. 71%. For a company that critics were calling a subsidized fantasy just 12 months ago, that number is not just impressive, it is a statement. The story has changed. The question now is whether you're positioned for what comes next. And what comes next starts with understanding a fundamental shift inside the company itself. The old NIO was a volume story. Sell as many cars as possible, worry about profitability later, and keep burning cash to chase market share. That story is over. The new NIO is built around something far more powerful, a high-margin pivot that is finally paying off. In the fourth quarter of 2025, NIO reported a $40 million net profit. Now, I know what some of you are thinking. In the context of a multi-billion-dollar company, is $40 million really a big deal? Yes, absolutely yes, because this is the inflection point. This is where the operational model proves it can scale without bleeding. And the key metric to watch going forward is vehicle margins. For this turnaround to mean anything long-term, those margins need to stay above 20%. If they do, NIO stops being just a car company and becomes what it was always trying to be, a high-performance, vertically integrated technology platform with recurring revenue streams and genuine pricing power. The engine is warming up. The real question is whether it has enough fuel. And to understand where that fuel is coming from, you have to look at one vehicle in particular. In April, NIO delivered over 29,000 vehicles, representing nearly 23% year-over-year growth. Impressive on its own, but drill into the data and one number stands out above everything else. The redesigned ES8 SUV accounted for 44% of NIO's total April volume, 44% from one model. And it's not just selling, it is dominating. The ES8 has ranked number 1 in China's premium large SUV segment for 5 consecutive months in a row. 5 months of segment leadership is not a fluke. It is a structural advantage. NIO has successfully cracked the code on capturing the high-end Chinese buyer, the customer who demands luxury, technology, and performance all at once. And that is precisely where 20% vehicle margins come from. But as impressive as the ES8 story is, it is actually the second most important competitive advantage NIO has. The first one is something their rivals simply cannot copy overnight. Let me show you the moat. NIO's Battery as a Service ecosystem, what they call BaaS, has now completed over 110 million lifetime battery swaps. Let that number sink in for a second. 110 million swaps. Each one represents a customer touchpoint, a data point, and a recurring revenue event that no traditional automaker and no standard EV charging network can replicate without spending years and billions building the infrastructure from the ground up. During the May Day holiday peak, just 1 week, NIO executed 1 million battery swaps. In that single week, their network delivered 16.3% of all electric vehicle energy consumed across the entire nation of China, 16.3% from one company. Think about the loyalty that creates. Think about the switching cost for a BaaS subscriber who has built their entire driving life around instant battery swaps. They are not switching to Tesla's supercharger network. They are not waiting 45 minutes at a public charging station. NIO has built a monopoly on the one thing every EV driver values more than anything else: time. And that infrastructure moat compounds with every new swap station, every new subscriber, and every million swaps completed. It is not just a feature, it is a fortress. Now, you'd think with fundamentals this strong, Wall Street would be unanimous in its conviction. But that is where it gets really interesting. What we are watching unfold in the institutional ownership data right now is nothing less than a war of conviction. On one side of the battlefield, you have BlackRock, the largest asset manager on Earth, who just increased their NIO position by 92%, adding nearly 11 million shares. They are not buying on a whim. They are making a calculated long-term infrastructure bet. Alongside them sits CYVN Holdings, with an anchor stake approaching 18% of the company, providing a stable, strategic floor beneath the stock. On the other side, UBS has slashed their position by almost 50%. JP Morgan Chase followed with a 48% reduction of their own. The same stock, the same data, completely opposite conclusions, and when the smartest money in the world cannot agree on a name, you get exactly what we've seen: violent volatility, sharp moves in both directions, and exactly the kind of setup that creates asymmetric opportunity for the investors who have done their homework. The institutions are split, the retail crowd is watching, and the catalyst clock is ticking down. But before we talk catalysts, we have to talk about the risks, because ignoring them would be doing you a disservice. There are two significant headwinds that every NIO investor needs to understand right now. The first is a $600 million securities lawsuit filed by GIC related to how NIO recognizes revenue from battery transactions with their partner, Wuhan Weineng. Revenue recognition disputes at this scale are not trivial. They can drag on for years, create regulatory uncertainty, and suppress institutional buying from compliance-sensitive funds. The second headwind is an active regulatory investigation into alleged battery-locking software that reportedly reduced vehicle range by 125 miles for certain customers. Range anxiety is already the #1 concern for EV buyers. If this investigation produces damaging findings, it could directly undermine the brand credibility that the ES8's 5-month dominance has so carefully built. These risks are real. They are not priced in by most retail investors, and they are exactly why a stop-loss discipline, which we will cover shortly, is not optional. It is mandatory. Now, having laid out the battlefield honestly, let's look at what the chart is actually telling us, because the technical picture right now is arguably the cleanest setup NIO has shown in years. Back in April, NIO printed a golden cross. That is the moment when the 50-day moving average crosses above the 200-day moving average, one of the most widely watched long-term bullish signals in all of technical analysis. As of today, the stock is sitting at $6.54, comfortably above its 20-day, 50-day, and 100-day moving averages. Every major short-term and medium-term trend line is now acting as support rather than resistance. And if you check the relative strength index, it is sitting at 50.41, right in the middle of the neutral to bullish zone. Not overbought, not overextended. There is genuine room to run before the technicals even begin to flash caution. The chart is not screaming. It is speaking clearly and calmly. And what it's saying is, the setup is intact. Now, zoom out a little further, and you will see the bigger picture. What has formed on NIO's long-term chart is a textbook cup and handle pattern. The cup itself has a depth of approximately 40%, a significant formation by any measure. And right now, we are carving out the handle portion of that pattern, consolidating just below the rim level at $7.13. In classical technical analysis, the depth of the cup is used to project the magnitude of the eventual breakout. Measure the depth from the rim, add it to the breakout point, and the mathematical trajectory points directly to $10 per share. That is approximately 50% upside from the current breakout zone. This is not a guess. This is not wishful thinking. This is a pattern that has played out across hundreds of stocks over decades of market history. The blueprint is drawn. The only question is whether NIO has the catalysts to pull the trigger. And in the options market, those catalysts are already being bet on heavily. The derivatives data is telling a fascinating story right now. Call volume is running at over 80% dominance. The retail crowd is leaning aggressively bullish. But here is where it gets structurally important. There is a massive concentration of call contracts at the $7 strike, over 87,000 contracts. This creates what traders call a call wall, a level where market makers have a significant financial incentive to keep the price pinned below $7 heading into expiration. Think of it as a ceiling held up by billions of dollars in options exposure. On the downside, put concentration at the $6 level creates a natural support floor. NIO is essentially coiled in a spring between a $6 floor and a $7 ceiling, and the force that could blow that ceiling wide open is already loaded and waiting. Short interest. 134 million shares sold short. That is the fuel in the tank. The days to cover ratio, which tells you how many days of average volume it would take for all the short sellers to buy back their shares, is sitting between 4.9 and 6.08, nearly a full week of buying pressure just to cover existing short positions. Now ask yourself, what happens when NIO drops a massive earnings beat on May 21st? What happens when the ONVO L80 launch tomorrow drives a wave of positive media coverage and delivery momentum? Shorts scramble for the exit. Every short covering trade becomes a buy order. The $7 call wall does not just crack, it disintegrates, and the squeeze that follows feeds directly into the cup and handle breakout. This is how the $10 thesis gets validated, not over months, but potentially over days. And the big banks are starting to say the same thing. Analyst consensus on NIO has meaningfully shifted toward outperform. HSBC recently updated their price target to $6.80. DBS Bank and Macquarie have both moved to buy and outperform ratings, and the headline here belongs to Nomura, who just lifted their peak target to $8.60. When institutional research desks start chasing the price action with upward revisions, it creates a self-reinforcing cycle of buying as funds rebalance their portfolios to align with upgraded ratings. The analyst community is not ahead of the price action this time. They are catching up to it. And that means there is still time for the market to fully reprice NIO toward fair value. So when does all of this actually happen? Here is your calendar. Tomorrow, May 15th, the ONVO L80 launches. This is NIO's move into the mass market segment, designed to capture a completely different buyer demographic than the premium ES8. If the launch reception is strong, it confirms NIO's ability to operate effectively across multiple market tiers simultaneously. Then, 6 days later on May 21st, Q1 2026 earnings hit the tape. This is the single most important near-term event for the entire thesis. Vehicle margins, revenue recognition clarity, BOS subscriber growth. All of it will either be validated or questioned in that release. Layered on top of all of this is a broad macro tailwind lifting the entire EV sector, with coordinated buying across multiple names suggesting institutional rotation into clean energy and technology plays. NIO is not running alone. It is being lifted by a rising tide. When you step back and look at all of it together, the $40 million quarterly profit, the ES8's 5-month segment dominance, the 110 million swap milestone, the golden cross, the cup and handle pattern, the 134 million short interest, the BlackRock accumulation, and the Nomura 860 target, every single data stream converges on the same destination. $10. It is the mathematical intersection of fundamental improvement, technical structure, and market sentiment. Not every one of these factors needs to play out perfectly. Even a partial convergence moves this stock significantly higher from where it sits today. So here is the trade structure as we see it right now. The current entry zone is between $6.40 and $6.55. Primary support sits at $6.50, with secondary support at the $6 level. A stop loss at $5.75 is your line in the sand. A close below the 200-day moving average would invalidate the bullish thesis, and that exit must be respected. Short-term target, $7.50, clearing the call wall. Mid-term target, $8.60, matching the Nomura level. Long-term target, $10, the full cup and handle realization. The risk-reward is asymmetric. The data is in. The trend is confirmed. Before we wrap up, a quick and important reminder. Nothing you hear on Smart Stock Sam is financial advice. All content on this channel is for educational and informational purposes only. I am not a licensed financial advisor. Always do your own research and consult a qualified professional before making any investment decisions. Markets carry risk, and past performance, including predictions made on this channel, never guarantees future results. Your capital is your responsibility. Please invest wisely. And now for the wrap-up, because if you have made it this far, you deserve a straight answer. NIO is not a perfect company. The lawsuits are real. The regulatory risk is real. The institutional disagreement is real. But the data, the deliveries, the margins, the swaps, the technicals, the short interest, all of it is pointing in the same direction. This is one of the most layered, data-rich setups we have broken down on this channel in a long time. Now here's the question I want you to answer in the comments below. Do you think NIO can hold those 20% vehicle margins through the rest of 2026, or will the mass market ONVO expansion compress them back down? That is the real long-term test for this company, and I genuinely want to hear your thinking. Drop your answer below. The debate in the comments on this one is going to be worth reading. If this breakdown gave you value, please hit the like button. It genuinely helps this channel reach more investors who are trying to cut through the noise. Subscribe if you haven't already, because the May 21st earnings reaction video is going to be essential viewing, and you do not want to miss it. And if you really want to support the work we do here at Smart Stock Sam, you can send a super thanks directly through YouTube. Every single one matters and deeply appreciated. It is what keeps this channel independent, unsponsored, and honest. The data is your edge. Use it. We'll see you in next update.